Hi, I'm Eloise Armitage, Director of Obsequium Consulting. So as you all know, in August 2015, ASIC handed down a report off the back of quite an extensive probe into the provision of interest-only loans, and that had a particular focus on 11 of the larger lenders, including those big four banks. So ASIC's particular focus was not only on how consumers were being assessed for these types of loans, but more so around the affordability of these particular loans over a longer term. So as part of that review, ASIC assessed over 140 client files, and the results were quite alarming, quite astounding. In over 40% of the files reviewed, the affordability calculations had just assumed that the borrower had longer to repay the loan than they actually did. And further to this, that in over 30% of those files, there was actually no evidence that the lender had considered whether or not the provision of an interest-only loan was in fact within the borrower's requirements and objectives. Now, jumping ahead to this month, then Westpac Banking is set to defend itself in the federal court against claims made by ASIC during this review period, and that'll be around its responsible lending conduct and obligations, and also its credit approval processes, obviously. So I guess what that means for brokers is that lenders will be watching them closer than ever as they perhaps become a little bit more fearful of this regulatory pressure and presence. But for Westpac, this actually means staring down the barrel of quite a hefty maximum civil penalty that a court can award for breaches of responsible lending laws, and that's around the $1.7 million mark per contravention, of which they stand accused of 7. So how can you go about protecting your business with respect to this particular issue? So ASIC stands by 3 key recommendations when covering yourself and your clients when you're entertaining the provision of an interest-only loan. So firstly, and we think this is quite an easy win, ensure that the loan aligns with the consumer's requirements and objectives. Secondly, that lenders use consumers' actual expenses rather than any benchmarking figures that may be available to them. And thirdly, and this is a very important one, not only because it can have significant ramifications, but also because ASIC has quite a spotlight on it at the moment, and that's that affordability assessments include any buffers for future potential interest rate rises. So keep that in mind, and that's really just a starting point of how you can protect yourself. But if you'd like to know more about this topic and how it may affect your personal business, please get in contact at obsequiumconsulting.com.au and inquire about a health check, and subscribe to our YouTube channel for further regulatory updates. Thanks.